What's up, everybody? I'm Logan Moody. This is the Contrarian YouTube channel. Today I'll be talking about an article Michael Burry retweeted, essentially implying that he believes the Fed will need to pivot early next year, if not sooner than that, because of the ever more illiquid bond market. So today I'll be talking about this article by Concoda that he retweeted. It's gotten a lot of attention, and it's a very well-written article, essentially going over the sovereign debt crisis and the likely tools that central banks could use to attempt to do some sort of financial alchemy to paper over the crisis yet again, like they did back in 2008. So without further ado, I'll dive right into this article Michael Burry retweeted. I will put the link down in the description to Concoda's Substack if you want to read this for yourself, but I'll be going through the majority of it right here because it really is just non-stop good information to cover. The title is "The Great Sovereign Debt Intervention is Here. Monetary Leaders Possess an Expansive Toolbox to Prevent a Bond Market Meltdown." And Concoda is going to go into all of the details of what these different tools are. Essentially, he first has to lay out the groundwork of where we are right now, how the bond market has gotten to the state of illiquidity that it currently is, and what this will prompt central banks to need to do. So basically, bond markets have been growing increasingly unstable lately, causing many to warn about a possible sovereign debt crisis unfolding. But monetary leaders now possess numerous mechanisms to prevent a catastrophe. The great sovereign debt intervention is upon us. Tasked with preventing sky-high inflation, mostly caused by issues beyond their control, supply chains, Federal Reserve officials have been forced into raising rates sharply to lower prices near their highly controversial 2% target. This will indeed cause significant pain worldwide. Rising interest rate differentials will spur a stronger US dollar, affecting the 50% of transactions invoiced in greenbacks globally. The Fed's gambit is to fight inflation, hopefully without blowing up other countries, through a rising dollar in scarce reserve. And already, the Fed has effectively blown up smaller economies around the world. Sri Lanka is a great example of this, where the rapidly rising dollar against their local currency caused a financial crisis there. It is also a big issue with how strong the US dollar is in relation to the yen and the euro, but that's a whole separate video entirely. But that is another major issue that Concoda doesn't necessarily point out, is the issue currently in the euro dollar market. But however, I'll keep going. With the potential for another 2% in rate hikes by March of 2023, in inflationary pressures continuing to build, further Treasury market turmoil is about to unfold. And then he shows us this chart essentially showing rates where they have been even just a month ago, where they currently are with regards to the target rate, and it has shown a dramatic rate increases just in the last month. And this can be seen across the credit curve. 10-year is now actually above where it was at the Lehman Brothers moment. So just this week, bond yields have risen to levels not seen since the failure of Lehman Brothers. This expansionary impulse of trillions in stimulus, plus the sharpest rate hiking cycle in decades, has caused significant dumping of treasuries. While yields have risen because of the market's perception of inflation, growth, and interest rates, rising volatility has exposed structural weaknesses, exacerbating a sell-off. America continues to issue twice the amount of bonds per year compared to pre-COVID levels into increasingly illiquid conditions. And this is essentially the situation we find ourselves at right now. Central banks around the world are offloading their dollar-denominated debt as quickly as possible, swapping it for other currencies, mainly their own treasuries, attempting to support their own system. We've seen this again with the BRICS nations attempting to move off of using the dollar as a means of exchange between each other. Concoda doesn't mention this, but this is also very worth mentioning that there's a lot of other changes out there that are contributing to a de-dollarization of the world. And as a result of this, there's less and less buyers for US debt out there who used to be large buyers. And so this also adds a significant selling pressure to the overall bond market, making it increasingly more illiquid. So basically, increased volatility, diminished liquidity, and declining market depth means further instability is assured, which will likely send bond yields even higher. Eventually, monetary officials must intervene, and with intervention comes monetary alchemy. Central planners now have an abundance of mechanisms to prevent what some assume to be a sovereign debt bubble from bursting. So, experts out there like Luke Gromen, others, are implying that this sovereign debt bubble bursting is inevitable, that it can't be avoided. At least I don't believe Luke Gromen would say that that's the most likely outcome. He would say that, like history has played out in the past, it's kind of inevitable that this bubble does burst. But Concoda and Burry presumably go a bit different of a direction, saying that it could be papered over again if these tools are used correctly. So that's a very interesting thought out there, that it's not necessarily the end of the US dollar existing. It could be another situation of financial alchemy, as Concoda calls it, and papering over everything again. So basically, he'll go into more examples now of what these tools are. With numerous tools in hand, however, officials will only resort to full-on yield curve control as a last-ditch attempt to rescue Treasury markets. Instead, at the earliest indication that illiquidity is becoming hazardous, the U.S. Treasury will respond with a different solution: buybacks. Using funds from either bond sales or its bank account at the Fed, the U.S. Treasury will repurchase bonds in the secondary market via primary dealers such as JP Morgan and Nomura to improve liquidity and suppress yields. Higher bond prices equal lower yields and fewer expenses. Buybacks also earn America the added bonus of reducing interest payments on its outstanding debt. And the interest payments that the U.S. is now facing is becoming ever more an issue, especially as older duration treasuries have to roll over into this higher interest rate environment. It becomes a much greater issue. For example, take a look back at the Lehman moment when rates on the 10-year were actually lower where they are now. And U.S. debt was actually only $6 trillion back then, as opposed to $31 trillion now. So this is a enormous difference. All of a sudden, we've 5x'd the debt load. All of a sudden, the rate that we're having to return other investors on our debt is ever more an issue. And so lowering the rates as quickly as possible is going to become a very essential a thing that central banks, the Fed, needs to do as quickly as possible. And so that is why they would do this Treasury buyback. And he helps us to understand this better. Step one, government raises money to purchase old treasuries. This could come in the form of using funds from the Treasury's bank account at the Federal Reserve, or use funds earned from issuing another treasury. And then the second step is governments buy the treasuries in the secondary markets from like JP Morgan, other large dealers out there, and send the previous owners newly issued bonds. And this is a helpful illustration, essentially showing how this would lower, this could have the potential to lower bond yields by essentially supporting the market artificially. It would definitely be interventionist. Previously, Treasury buybacks have been an effective tool for suppressing bond volatility, yet they are unlikely to dampen today's record high levels. According to Concoda, this tool won't go very far. Looking at this volatility index of bonds, Merrill Lynch's, in fact, Treasury volatility estimate, we can actually see that it briefly spiked in November and December of 2020. And then around since June of 2021, it's had a steady climb almost back up to this level. So this is concerning to see that it's climbing dramatically and it doesn't show any signs of really going down. So it's becoming ever more increasingly illiquid, and it's been a longer trend. Officials will have to fire up their next mechanism, indirectly incentivizing large financial planners to purchase more treasuries. So this would come in the form of requiring banks to hold more treasuries. This, however, is harder than it sounds, Ever since the Great Financial Crisis, banks have become balance sheet constrained, a fancy way of saying regulation has prevented financial entities from taking on too much risk in certain situations, like buying a truckload of treasuries, even if it is beneficial to the system. So basically, in the aftermath of the Great Financial Crisis, the Bank for International Settlements, BIS, the self-described central bank for central banks, introduced its third round of rules, the Basel III Accords. This set out a plethora of rules and regulations aimed at preventing future crises. So basically, they're taking a hard line against fraud-ridden bubbles like the subprime mortgage-backed securities, requiring banks to retain a lot more capital relative to their assets, a higher capital ratio to comply with regulations. And so as you can see, in this ratio, basically ever since the Great Financial Crisis, it's been elevated. However, it has dipped down in the last year, as we can see. Not anywhere near back to where it was, but it has dropped a little bit. And so that again shows how, he'll go into this later, but that is actually presenting an issue again. They had to retain enough high quality assets, which included such assets as bank reserves and treasuries, to meet their liquidity coverage ratio. This regulation has required financial institutions to hold 30 days worth of high quality assets so they can handle customer outflows during a crisis. So basically, still with this large safety net, big players have not been buying enough bonds to foster normal levels of volatility in treasury markets. That's likely because there's twice as many treasuries being issued now as prior to COVID. Bond market chaos ensues. Monetary officials will modify another rule, the supplementary leverage ratio, or SLR. The SLR directs banks to hold around 3 to 5% of their capital against unweighted assets, meaning even risk-free interbank reserves and treasuries are deemed just as dangerous as risky investments like mortgage-backed securities. And basically, with what happened after COVID, they needed to be bailed out, and so they raised the SLR ratio, and then they just dropped it down last year. And as can be seen by this chart, immediately banks, offloaded as much as they could because, the essential goal of any bank is to make as much money as they can. And if your money is not being as productive as it could be, you're going to put it where it would be more productive. And so they immediately offloaded this excess liquidity that was put in place after COVID, or in response to COVID. And yeah, it can be very dramatically seen what they did there. So when Treasury buybacks prove ineffective, authorities could entice big players to gorge on a larger number of treasuries instead of being mere middlemen. Multiple bureaucracies from the FDIC to the OCC must sign off to provide SLR relief, but in a panic, there will be no indecision. That's a nice way of saying that in a crisis, it's going to move very quickly. Free from the constraints of the SLR, large banks will be able to absorb a larger number of bonds at no cost to their regulatory ratios. But they must be willing to buy, and if they aren't enticed, authorities must increase the temptation to buy them. And before going into full yield curve control mode, the Fed will try imposing a soft ceiling, announcing they'll temporarily buy a certain amount of treasuries at a set rate. Market players will likely join in and treasury volatility will wane, or so you would think. In the last few months, however, an alternate prophecy has emerged in mainstream financial circles. Prominent thinkers have predicted that inflation could persist even after every major supply issue has been resolved. That could mean higher bond yields for longer. So essentially, the Fed will not go into full yield curve control until they absolutely have to. They could essentially try to do more quantitative easing, of course, calling it different names now, maybe some slightly different rules behind it, but it would be QE nonetheless, of course, which is just the Fed buying bonds. So those who believe that inflation will stay elevated for longer argue that since global demographics and globalization have peaked, the subsequent impacts will cause a structural shift toward persistent inflation. And actually, Michael Burry has tweeted about this in the past, that he believes persistent inflation will remain longer for these exact reasons: demographics and a reshoring of supply chains. So that is really nothing new for Burry. He's definitely behind this. But there's a slightly contrarian prediction that Concoda and concurrently Michael Burry seem to have. Concoda predicts authorities will try to cling to the status quo of lower yields for as long as possible. In response, they will utilize a new set of tools to maintain lower bond yields in a persistently inflationary environment. So essentially, yields will keep going more negative as inflation persists to stay higher, if it does in fact stay higher. And also the Fed will need to bring yields way down in order to maintain any sort of consistency with the status quo. They need to bring yields way down from where they are right now. So basically, Fed officials will eventually start to utilize their most powerful tool, yield curve control, imposing an upper bound with the ability to create infinite amounts of money in the form of bank reserves. The Fed can then buy as many bonds as they need to suppress yields. So, of course, this would be the QE infinity that everyone has been referring to. It would not be perhaps the most broad-brushed quantitative easing that we've seen in the past to the Great Financial Crisis and then since then, but it would nevertheless be quantitative easing, essentially the Fed backstopping the bond market should a certain section of the yield curve exceed a certain level. They would step in and back to whatever extent they needed to at that point. Concoda says it's unlikely to reach such a situation, but if the U.S. could then mandate citizens to buy government bonds, they might do so. This would, of course, be a very direct and personal way of people understanding this is a very a significant change that has taken place, that not only can they now not invest in certain things, but they have to maybe buy a certain ratio of treasuries in their portfolios. I don't know about you guys. I don't hold any treasuries. Obviously, they're in very negative territory right now. You might as well hold basically anything else because they've done very poorly recently. But needless to say, the maybe average consumer interest in treasuries in regards to their own portfolios is very, very low right now, especially if you're not anywhere close to retirement. Very, very low interest rates. So they might actually go and do something like this. Concoda doesn't think that's very likely. But he nevertheless says monetary and fiscal alchemy will be pushed to new limits, though, as Concoda has stated before, we won't even come close to a U.S. sovereign debt collapse that many have warned about for decades. Actually, Michael Burry did give a brief talk at his alma mater, Vanderbilt University, in which he answered a question about shorting, and he kind of gave an answer that it'd be very unwise to ever go short U.S. Treasuries, because at a certain point the Fed will step in and back that market to whatever extent it needs to. So I don't know how sure any of you are about the sovereign debt actually collapsing, or if it just gets printed into infinity, but it's definitely a one or the other. It's not going to be a return to normalcy at this point. I think everyone can agree there. Concoda apparently believes that we won't see a touted debt jubilee, just with how interconnected everything is at this point. That's likely not going to happen. He says also that the U.S., meanwhile, is paying off around a quarter of its liabilities free of charge for the U.S. at least. This is changing as we speak, with quantitative tightening, of course. So the Fed is forcing citizens who don't want to offer the government an interest-free perpetual loan to fund more of America's future debt load. So this could be essentially why Michael Burry is saying that quantitative tightening especially needs to end, and likely ends beginning of 2023 or around there. So if what Michael Burry is warning and Concoda are warning does happen, could expect more volatility in the bond markets going forward until the U.S. Federal Reserve and other central banks step in. that's likely to not go anywhere. In fact, it could get a lot worse. So also, I'll point out that the Fed is likely to only pivot when something breaks. And as Luke Groman and others are saying, this actually could happen a lot sooner than the beginning of 2023. In fact, it already could be going on, but obviously we'll only be able to tell looking in retrospect when things actually started breaking. So it's obviously in the future, and when it does actually happen, we'll be looking back in the past at all of it. It could actually be occurring relatively soon. But Burry believes that this could come next year, early next year. And so, yeah, I don't know what much else to say. This basically paints the picture of where we currently are in the sovereign debt market, how increasingly illiquid this market has become, the backdrop of the situation for why the Fed and all central banks will need to step in as big buyers of their own debt in order to keep the system afloat. Of course, this Concoda essentially is implying that this will kick the can down the road again, that it won't be a sovereign debt bubble that actually bursts. It'll just keep getting bigger. I don't know what all of you guys think about that, but feel free to comment down in the section below what you think is more likely. Does the Fed actually paper over this situation again, just with astronomically more quantitative easing than before, or does the bond bubble actually burst this time? So all that being said, let me know what you guys think about this video. I'll put the link down in the description for Concoda's article, and feel free to follow him out there on Substack, follow Michael Burry out there on Twitter. But if you guys like this video, just consider giving it a thumbs up, subscribing to this channel. Hope to see you all again at some point.